Good evening, everyone. It gives me great pleasure to welcome all of you to today's Integrated Business Solutions case study session organized by Board of Studies Academic ICAI. Students, IBS is one of the most unique paper at CA final level. Unlike traditional papers where questions are generally presented within the boundaries of individual subjects, IBS requires you to think across subjects and look at a business problem from integrated perspective. In this paper, you will need to connect concepts from financial reporting, auditing, taxation, law, advanced financial management, strategic cost management. The objective of IBS is not simply to test your technical knowledge. More importantly, it tests how effectively you can apply that knowledge to a real business situation. As future chartered accountants, you may be required to advise management, analyze business problems, evaluate various alternatives, identify risk, ensure compliances, and most importantly, help in creating value for the organization and its stakeholders. That is exactly the kind of professional thinking that IBS is designed to develop. Therefore, while attempting an IBS case, always remember one point: there is rarely a single subject solution. You need to look at the case as a whole, identify the different issues, understand how they are connected, and then arrive at a practical and business oriented solution. Today's session has been designed with the same objective to help you understand this integrated approach and develop confidence to handle multidisciplinary case studies. Let us understand this approach through a simple example from automobile industry. The automobile industry is changing rapidly. Customers are looking for safer, more fuel efficient, and technological advanced vehicles. At the same time, electric vehicles, connected cars, digital sale platforms, and changing environmental regulations are transforming the industry. For an automobile company, therefore, the challenge is not simply to manufacture and sell more cars. It has to continuously take strategic decisions relating to technology, product cost, financing, supply chain, taxation, regulations, and customer expectations. Let us take a simple example again. Suppose this automobile company is currently manufacturing petrol and diesel vehicles, and management decides to enter into electronic vehicle EV segment. At first glance, this may appear to be simply a strategic decision, but in IBS, we need to go beyond that and examine the complete business situation. The first question management may need to consider: should the company develop the technology itself or acquire an existing EV technology company? If it decides to acquire another company, several questions immediately arise. How should the acquisition be financed? Should the company use the internal funds, borrow money, or issue equity? This brings in advanced financial management. Management will also need to evaluate whether the proposed acquisition will actually create value, what is the expected return, what are the associated risks, what will be impact on company's capital structure and cash flows as well. Here, financial management and strategic management come together. Now, suppose the company decides to manufacture the battery packs itself rather than purchasing them from an external supplier. This could be a case of vertical integration. Now you are trying to move vertically. The company may either establish its own battery manufacturing facility or acquire an existing battery manufacturing business. This leads to another important question. What will be the cost of manufacturing the battery? And is it most beneficial to manufacture it internally or purchase it from an outside supplier? This brings in strategic cost management. We may need to consider relevant cost, capacity utilization, economies of scale, opportunity cost, and the long term strategic benefits of the decision. Now, suppose the company has various divisions: battery division, EV manufacturing division, sale or distribution division. The battery division supplies battery to EV manufacturing division. The next question is, at what price the battery division transfer the batteries to manufacturing division? This brings us to transfer pricing, divisional performance evaluation, and goal congruence. So, a decision that initially appeared to be about manufacturing electrical vehicles has now connected with cost management and performance evaluation. But the integration does not stop there. Suppose the company develops a new battery technology, how should the expenditure incurred on developing that technology be accounted for? We now need to examine the relevant provisions of Ind AS and determine whether the expenditure qualify for recognition as an intangible assets or need to be expunged. Ind AS 38 is applicable. Now, consider the tax implications. The company may receive incentives for manufacturing electric vehicle, import certain components, export vehicles, or establish manufacturing facilities in different locations. What are the direct tax and indirect tax implications? Once again, another dimensions of the same business decisions come into play. Simply, there may be regulatory requirements relating to vehicle safety, environmental standards, battery disposal, data protection, and other statutory compliances. This brings corporate and other laws and regulatory compliances into picture. Finally, management needs assurance that all these processes are operating effectively. Are adequate internal controls in place? Are procurement and inventory processes properly controlled? Are battery related risks being identified and monitored? Are statutory compliances being followed? Is there any risk of fraud or financial misstatement? These questions bring in auditing, assurance, risk, and internal controls. So, students, look at what has happened. We started with just one business decisions. Should an automobile company enter the electric vehicle market? But that single decision has connected almost the entire CA final curriculum. Strategic management. Should we enter the EV market? AFM. How should we finance the expansion? Financial reporting. How should development expenditure and other transactions be accounted for? Strategic cost management. Should we manufacture batteries or buy them? Direct tax. What are the tax implication and incentive? Indirect tax. What are the GST and other indirect tax implications? Law. What regulatory and legal requirements must be complied with? Audit and assurance. What are the risks and what control should be established? And this is exactly what IBS wants you to do. When you see a case, don't put it into separate box and think this is an AFM question, or this is a costing question, or this is an audit question. Instead, think like a chartered accountant advising management. Ask yourself, what is the business trying to achieve? What decisions does management need to take? What are the financial, accounting, taxation, legal, and risk implication of that decision? What alternatives are available? And finally, what would I recommend to management and why? Why I recommend this decision? This is the difference between knowing the subject and integrating the subjects, and that students is the real essence of integrated business solutions paper. The case study has already been uploaded on knowledge portal. I encourage all of you to go through the case carefully so that you can get maximum benefit from today's discussion. You are also welcome to ask questions during the session and make the discussion as interactive as possible. Before we begin, I would like to briefly introduce today's speaker. Earlier, CA TV Balasubramanian sir was scheduled to conduct this session. However, due to some unavoidable circumstances, he could not join us today. We are therefore particularly privileged to have with us CA Rajkumar Sharma sir, Partner Risk Assurance and Consulting PKF Sridhar and Satnam LLP. We are especially grateful to Sir for accepting our invitation at such short notice and joining us despite his busy professional commitments. Sir is an assurance and consulting professional and over 3 decades of experience with extensive experience in risk assurance and consulting engagement in India and overseas, including USA, Europe, Middle East, and Republic of Maldives. He has undertaken extensive assignments in areas such as internal financial control, enterprise risk management, regulatory compliances, internal audit, and consulting, with a strong focus on aligning control with business objectives and providing practical and value adding solutions to complex business situations. His extensive experience across different industries and his practical insight will certainly help us understand how the concepts we study in our curriculum are applied in real business situations. We sincerely thank Sir for joining us today and for taking the time to share his valuable knowledge and professional experience. With these words, let us begin today's session. I now invite CA Rajesh Sharma sir to take us through this interesting and thought-provoking case study session. Sir, over to you.
Thank you very much, Deepak. I think it was nice to get introduced, and you have rightly indicated a good context to integrated business solution related scenario discussion. In my discussion, or rather in my introduction, though good information about me have been given, but one thing which is missed out, and that should excite the student, is that I am a rank holder in CA final and CA inter both, and I have got multiple subjects highest marks in India. So I definitely would like to give you a hint that in this subject you can very well score a very good marks, and at the same time you can excel well from the specialist to a generalist scenario, which is the ask of the modern day. I would like to say one thing, that there is always a question which is asked, that who is a better positioned, I would say, personality, whether a generalist or specialist. Of course, earlier it used to be specialist, but now I think generalists are the key and focus and leaders when it comes to providing business solution. Because if you are a taxation expert or specialist, probably you would not be able to do justice to various strategies which are hovering around the strategy of operations, the finance, and other related, I would say, areas. And hence, as a chartered accountant, I would give more importance to generalist as compared to specialist. And this subject is very well asking us to excel in a generalist kind of scenario. So with this background, let me take one out of the two case study that we are going to focus in today's discussion. Is Deepak rightly indicated that an automation industry's example is a very, very apt, I would say, example to demonstrate the need of integrated business solution. And I would like to extend that indication through this first case study, which is more on a P-Care product case study terminology that we have used, and it is hovering around the transportation related strategies and requirement. So maybe I would like to give you a background of this case study, though the case study is available to you, but it always give a good understanding when we deliberate on it. So in this case study, we come to introduction of the company and its problem. And I hope my screen is visible to all. Maybe in the chat, if I can get some indication, I would be happy to continue. Otherwise, if I would say, I think, Deepak has already indicated that it is visible, but I just wanted to double check whether it is.
Yes, sir, it is visible.
Excellent. Okay. So now coming on the case study, now this case study is with respect to P-Care products. It's a major Indian FMCG player in personal care product, and it is serving both urban and rural market across India. Now we are focusing on its South India operations, and we would like to indicate that this company has been catering to these urban and rural market through a wide supply chain, which involves C&F agents, distributors, and the last mile delivery partners. So it's a beautiful extension of the automobile industry's ultimate use in a FMCG player. Now, to maintain speed and pricing efficiency, the company depends heavily on the cost-efficient secondary freight and optimized logistics. So they have adopted a hub and spoke model whereby they have a C&F hub in two centers in South India. One is at Pollachi, which is in Tamil Nadu, and second is at Vijayawada, which is in Andhra Pradesh. Now, these are the two critical nodes in their southern distribution network. Now, these hub, as usual to the setup, they manage stock, they coordinate with the dispatches, and they cater to a wide dealer base across district with a very high dispatch on a daily basis and to a various locations. The efficiency of route planning, the fuel usage, and the vehicle deployment is very critical. And hence, this particular case study talks about to address these aspects, more focusing on regulatory compliance, and those compliances and regulatory requirement are pertinent because of the split that has happened between the erstwhile Andhra state into two states, that is Andhra Pradesh and Telangana, and it also have an impact on the cost control strategies, the GST compliances, and hence an integrated business solution is the need of our when we talk about this case study. Now here, just further, we would like to update that this company has a decentralized warehousing model, and by and large, this model is managed by C&F agents, and those C&F agents are located near the high demand zones. And the idea of locating these C&F agents at high demand zone is to reduce the delivery time and the freight cost, which is quite obvious for a success of a FMCG giant like P-Care. Now, in these two hubs that we are talking about in our case study, that is Pollachi and Vijayawada, Now, they handle daily dispatches of high volume packed goods. Similarly, the dealer coordination is done across the southern district. Similarly, the independent freight planning with support of sales team is also being undertaken. Now, at present, you assume that the company follow a hybrid transportation model. That means they have C&F on vehicles. Similarly, they are hiring the trucks. Of course, they are also undertaking the flexible deliveries through parcel services. So overall, I think this is a beautiful structure that they have developed, which is very agile. But yes, with this agility, it also warrants that there should be a very tight cost control. There should be very efficient route planning. And we have to ensure that in light of external event of various development which are happening around in the compliance ecosystem and politics, we need to see that those compliances are also being taken care of. So obviously the efficient hub level operations are key to fast distribution, inventory accuracy, and cost effectiveness, last mile delivery. So this is a perfect example that we are setting in our case study. Now you can also understand that the company's background is that they have a manufacturing setup in Madhya Pradesh, that is in Indore. Similarly, they have across India various regional C&F based warehousing model. Now, in this case, as we indicated earlier, we are talking about the Southern India distribution model. And here we are focusing on distribution of southern region with the help of these two Pollachi and Vijayawada hubs. Now, Pollachi takes care of servicing of Tamil Nadu and Kerala, two key districts. Similarly, Vijayawada takes care of the Andhra Pradesh, Telangana, and nearby markets. So this is the overall coverage which they are handling. And these high volume hubs are very critical and they play crucial role in reaching to various tier 2, tier 3 and rural retailers very, very efficiently. I would also like to make a parallel here is that similar approach is adopted by diagnostic blood testing or those kind of entities also, whereby they have a key laboratory where the blood tests are being undertaken, and to collect the blood samples from various locations, they follow this hub and spoke model, whereby the collection centers are wide spread across various tier 2, tier 3 and rural location, and then the samples are being collected and it is being taken to the hub level center. So like here, there also the cost efficiency is one of the critical aspects. So now coming back to our case study, this company P-Care Products, it takes care of the southern India distribution through Pollachi and Vijayawada hubs. And please make a note of the two events that has happened in this location, that is South India, is that there were split of Andhra Pradesh into two states. So which has a direct implication on the GST compliances, the registration and various other requirement. I'm sure all of you would be knowing it. So this was one key event that has happened, which was bothering them. And that's the reason this actual example of what we have done for them is being presented to you. So this is one important background information which you should take note of. Similarly, post the VAT assuming in a new act which is called GST across India, so that change also has a major impact in their compliance requirement. So I think if you see the overall context of this case study, imagine a company which is having a very good manufacturing facility in Indore. It is reaching across India for their product through hub model. And in South India, they are having 2 key warehouses or hubs from where they are reaching the corner and nooks of tier 2, tier 3 and rural Indian villages and retailers for distribution of their product. And now you see the situation that at each of these locations, which is we are calling it as a C&F hub. Now they have chosen this particular hub in South India mainly based on their legacy dealer network. Legacy dealer network means from ages it has come like that. So for several years it is continued, and hence it's a legacy dealer network which they have inherited, and whatever infrastructure and aspect which they have developed over a period of time to enable the broad geographic reach, they have developed this C&F hub in Pollachi and Vijayawada. Now this is definitely an important I would say information. Why? Because genesis of any company of efficiency and operation comes and evolves over a period of time, and hence here also this company is a mature organization, and they have evolved through various systems. Now this is one of the systems. Now here, when we went into the next level of depth, we observed that as the retail demand grew, the fuel cost surged. I think these 2 parameters have started bothering the organization, and in view of the legacy dealer network, there was a need of data-driven trip planning that came into picture, which was not there with them. And hence, when we started with this, I would say consulting engagement as a CF firm service provider, we found a higher level key issues like this, that the organization had a manual and experience-based routing with the minimal load consolidation. I think this is a typical problem in any transportation or logistic functioning in any FMCG kind of organization. If it is a mature organization which is there since ages or decades, then obviously you will find that manual systems are there, and based on the experience of the people who are working, they are doing a route planning, etc. And there sometime, and majority of the time rather, the load consolidation is avoided, and hence this issue. Similarly, there were partial load trips which were happening frequently. Now, this definitely increases the fuel cost and vehicle wear and tear, since there were certain, I would say, portion of their transportation which they were using their own or leased, vehicles. Similarly, since they have outsourced the logistic services, the visibility with respect to the cost and various other MISs with respect to the what we can say route of the vehicle which is being used, the timing observed, the various other cost related aspect, diesel cost per kilometer, etc. They were not knowing it, since it was an outsourced logistic services. And as indicated, the route planning was not automated and trip level analytics was not done. The possibility of unnoticed cost leakage cannot be ruled out. So I think all in all these aspects has given a clear-cut indication to us as a service provider, or rather for you as a student. You have to now evaluate the overall situation, and you can easily find out one lesson that we can learn from this strategic decision making point of view is that when the systems are evolved over a period of time, you need to do certain changes. What was done initially cannot be seen as a viable scenario for a very long period of time, and in the current and contemporary requirement, when the changes are happening with very fast pace, cost efficiency and cost controls are driving every organization, you can't sit idle, and hence strategic logistic decision must be evolved over a period of time. And this was one of the key aspects which we could sense at the beginning of the assignment. Now I think what we can see, we can discuss on a very specific aspect of whatever macro level challenges that we have identified for these two hubs. Right? So now let's see, when we talk about Pollachi hub, now here, once we started gathering the data, we also found that 20% of the service town were near the hub. So that means 80% were beyond this particular hub. Similarly, key towns like Trichy, Dindigul, Tanjavur, those were inefficiently routed via Pollachi, because these are big towns. And the Pollachi hub was used for servicing these locations as well. Now, those has resulted in a longer trip. Obviously, when the trip distance is higher, the fuel usage will be higher, and there would be time that would be taken more with respect to completion of these deliveries. Now, we also have to see one more thing, that the fleet of their own trucks, etc., we found that they were old trucks which are in use. So that has also given us a very interesting scenario, that the fuel cost per kilometer was very high, and that was also bringing down the efficiency, right? Now, there was a lack of trip consolidation, so that has also indicated a situation that there were very repeated deliveries which are happening at the same location in a very shorter period of time. So these were the key challenges which have been identified for Pollachi hub. Similarly, for Vijayawada hub, we observed that the parcel services were excessively in use, even though there were many instances that could be highlighted that the full truckload could have been utilized. And the moment you do a delivery with full truckload, cost efficiency automatically comes in. So I think that was one of the crucial aspect which was seen from the Vijayawada hub's problem or point of view. Similarly, because of this parcel service versus the inefficient use of full truckload delivery mechanism, there were huge extra cost which were incurred in this entire logistic arrangement. Now, in all, the shipment clustering was not happening. Clustering is a very good mechanism. Pooling or bundling is a very good mechanism to reduce the cost and to increase the vehicle utilization. So that was not happening here. Similarly, post bifurcation of Andhra Pradesh and Telangana, there were compliance requirement that has also set in. And hence, it was very clear to the management that a cost optimization review needs to be undertaken, whereby focus has to be given on route planning, the fuel efficiency of the vehicles in use for logistics, the freight strategy, since outsourcing was done, transportation services were used, and similarly compliance assurance needs to be looked into. So now you can see in the current situation, an integrated business solution of servicing is needed. You have to take care of compliances. You have to ensure that your timing is well taken care of for servicing your customers. Your vehicle utilization, if you are using in your transportation, is required to be undertaken. And similarly, when you are using the third-party service provider or transporter for parcel services, the freight strategy of bundling, whether it is happening properly or not, have to be evaluated. So I think this was the precise requirement, and the engagement letter between the client and the service provider were very focusing on clear-cut cost optimization review. And the moment you look for cost optimization view, you have to understand one thing, that compliance is done only. Without compliance, no cost strategy can work. Similarly, operational efficiency, no cost optimization can happen without operational efficiency. So a mix of operational efficiency, cost optimization, and compliance assurance and process improvement is what we are talking about. So this case study, students, is very excellent example of what we as a chartered accountant can do for clients like this. So again, just to give current operational process, because now we are building up a very good case study, and I'm trying to provide you all the minute details so that when we go for the question answer session, you will definitely get some very good insight, and your awareness about the minute aspect is also there, so that you can not only participate in a better way, but your understanding also goes for the next level. And this is the perfect good example of using theory for a very good practical use. The moment you start aligning your theoretical knowledge with the actual live problem, friends, I'm sure you will get a very good perspective. You would appreciate the kind of content that we learned in our study, and then using it in real-time world problems solution. Right? Now, coming back to this aspect, so let's see what we have done, what kind of additional thing when this assignment was executed that was done. So the Polachi and Vijayawada C&F hubs, since they were managing large monthly dispatch volume across various stockist cluster, and despite steady outbound volume, since delivery efficiency and cost control were not consistent at these two locations, we went into the diving deep on the data those are available. So we have collected data, we have done root analysis, because I'm sure everybody would be knowing that when we look for the logistic and transportation problem, we need to know how the transportation is happening in a particular area, and what are the various routes that has been managed and adopted over a period of time to serve these services or these places, ultimately service to our customer. Now, we observed in case of Polachi hub that 80% of the dispatches are routed to areas which can better served by Trichy, which is one of the very bigger, I would say, town when we compare with Polachi. I think this was the obvious aspect. In fact, let me take liberty to go to the next slide, where you can easily see in this particular India map that this is Polachi, where the organization had their hub. Now, this hub used to serve the customer at various locations like these, which is mentioned here. I think you can easily see those red circled locations. Now, I go back to my earlier slide, where this is one clear-cut instance that we found that 80% of the dispatches were routed to areas which can easily and better served by Trichy. Number one. Number two, there were longer trip distances. The moment we start looking for serving Tanjavur, Karaikudi, and Pudukkottai. So I think, this we have already indicated you. Similarly, the fleet of the organization which they were using, it was having aging vehicles. And the moment you start using the aged vehicle, fuel inefficiency creeps in, and there is a frequent breakdown and non-availability. So those additional challenges also come. But I think as long as it is being used, your cost per kilometer is going to be very high because it is a fuel inefficient trucks because of its aging. Now, I would say that there were frequent repeat runs which was happening to the same area. Now, the moment you have this, obviously there would be a inflated trip counts and turnaround time. More you use, more you pay. However, the cost in proportional to the revenue, it keeps on increasing, and that is the reason we could easily see that there were avoidable fuel cost and the freight cost which is happening. So these inefficiencies pointed out clear-cut need for route rationalization, modernizing the fleet of the vehicles which is in use, and then also looking for the location reassessment strategy. So students, you can see that there are multiple aspects that we are talking about. We are talking about operational efficiency. We are talking about fleet modernization. We are talking about location reassessment strategy. So now we have done a further deep dive on these other hub. This is what we discussed on Pollachi. Pollachi is for the Kerala and Tamil Nadu area, and now for Andhra and nearby location we use Vijayawada CNF hub. Now here also the stock movement was centrally managed, but it was over reliance on the parcel services. Even when the full lorry load was possible, the over reliance was there for parcel services. So multiple trips were used to happen in the same week, though it could have been easily managed with 2 or 3 2 or 3 days of trip only. Now, the key challenges here which we found in Vijayawada was that there was no dynamic route planning. There were scattered delivery which were happening. Similarly, the dealer clustering and trip bundling was totally missed because we were using the manual experience resources planning. It's also the moment you go for those kind of things when you are not using tools. Now, today is the era of AI tool uses. But here in this, for the sake of simplicity, we are not going into that scenario, but still it is very easy to do a bundling and clustering the moment you start using some sort of spreadsheet analysis and automation rather than totally relying on manual planning. Similarly, the vehicles which were in use, those were underutilized, as rightly indicated earlier, that the parcel services are over relied, and hence the per empty logistic cost was relatively higher. Similarly, there were inadequate shipping consolidation and inconsistent trip frequencies which have also been observed. And to add the complication for this location, you all know that in 2017, once the VAT was converted into GST and the state bifurcation has happened prior to that, so that has given Vijayawada one more additional compliance requirement, because they have to see to it that the dispatches which are happening to 2 states as against earlier 1 state need to see to it that GSTN allocation, the invoicing, the e-way billing norm, etc., those are being changed appropriately. Now, and hence both these hubs requires a structural reset in the fleet or rather freight planning, the regulatory alignment, and the route level efficiency to optimize cost and service platform. Service performance. So I think this is the overall aspect for both these hubs in southern India for PK. Now, when we talk about the cost and route analysis summary, again, very interestingly, a route cost and efficiency comparison between these two hubs highlighted various disparities, which probably we can highlight like this. 3 bullets for each of these hubs. For Pollachi hub, the routes to Trichy, Mailadurai and Tanjavur were serviced from in a very, very sub-optimal location, that is Pollachi, which I think, in the next slide, we will try to indicate you why it is so cost inefficient. Because the moment you serve even these locations, you find that the kilometer in use is very high, and the moment kilometer usage is higher, or rather, kilometer run is higher, the per metric ton dispatch is in cost inefficient. And in addition to that, since the company were using the aged trucks, so that was increasing the diesel cost and per cost in a inefficient way. So, and hence I would say Pollachi was more from the perspective of relocation of hub, or it is because of the use of aging truck that the per kilometer run cost was very high, and it was making additional cost burden on the organization. So Pollachi hub has these 3 key operational disparity. Similarly, in case of Vijayawada, again a similar situation, that there were some better locations like Guntur, Nellore and Rajamundry, which were having a better proximity. However, over-reliance on the parcel services, even for sub 150 kilometer route, drives our per metric ton logistic cost to the next level. Similarly, there are missed opportunity to leverage full truckload dispatches and structured trip planning. I think these were the 3 bullets which could be identified for improvement as far as Vijayawada hub is concerned. So I think all in all, what was the conclusion? The conclusion is that at both the hub, there is a huge room for improvement. Pollachi in routing location and Vijayawada in load consolidation and dispatch strategy. Now, I think before I go to the scenario analysis, I think we would also like to talk about this particular exercise which we have undertaken. What we did, we have tried in case of the Pollachi hub, as we were talking, that Trichy was considered to be a better option. Similarly, in case of Vijayawada, I think a similar exercise was done for Guntur, Nellore and Rajamundry. Now, let's focus only on one particular analysis, so that it gives you a good clarity as to how this study is further undertaken by consultant. So, as you can see that Pollachi has a very, very big competitor in terms of Trichy as a hub location. So what we did analysis of all the dispatches for 1 month. So that means for October month, whatever dispatch that has happened from Pollachi, we have noted those dispatches, and based on the several years of experience, whatever route that they have planned, we have listed that. So you can see that in this table, there were around 11 routes that had been evolved over a period of time for dispatches to be made from Pollachi to the last level, or last, I would say, retailers that we have in this particular region, which is served by Pollachi. Now, there were 11 routes. So we made a complete analysis of various locations covered and the distance which has been, you can say, seen for servicing. How many kilometers run has been done in each of these routes, covering these many locations. for Pollachi. So once we came out with that scenario, now we replaced it with the Trichy hub, and considering the overall location requirement, if we happen to serve or dispatch the material from Trichy to this location, then how many kilometer run each truck or vehicle would be doing? So we captured those kilometer, and then we compared the same for each of these route and came out with the difference in kilometer, which we could see now here in the fifth column. Now, as you can see that almost in majority of the route, the excess kilometer which is run if we are servicing from the current location, that is Pollachi hub, is very high. And based on the number of trip that has been undertaken, which is the second last column, we came out with the differential kilometer if we have these two alternative in front of us, whether Pollachi hub to be considered for servicing the various location or Trichy to be considered. Now, the moment we came out with this, yes, there were certain routes where when you are servicing from Trichy, you are having excess kilometer run. Like for example, in route number 5 and route number 7, as against the current lower kilometer, we are ending up having more than 326 and 201 kilometer run. But however, in these kind of studies, you have to take a holistic view. You can't select only those routes where we have advantage, because we are evaluating a preposition whether Pollachi hub should be replaced with Trichy. And hence we have to do a complete 100% route allocation through this, and accordingly, whether it is throwing us a positive or negative scenario, we need to consider that. And accordingly, we found that only in the month of October in this company, in this particular region, some 7,165 kilometers of run can be saved the moment we start addressing the dispatches from Trichy instead of Pollachi. And now if you translate it into a saving, for each of the kilometer, around 14 rupees per kilometer is the cost that were prevalent, and hence around a lakh of rupees saving was clear cut available when it comes to this particular location. Mind you, these are very basic level figure. The actual figures and the count would be very high. But as an example, at one of the location, we can say month, we are talking about this much of saving. And as the business grow, these figures are going to increase only. So, and hence, is indicated that routing through a better location was one of the very good possibility which were indicated in this deep diving of data analyzed for 1 month. Now, interestingly, you also have to consider, student, one thing, that when we are talking about these kind of alternative comparative study, we should also happen to remember one important aspect, that the manufacturing unit is providing the product to be housed at these hub. So the distance between the manufacturing plant and each of these alternative hub should also be considered. So we did that also, which is mentioned in this particular slide. So when we look into the benefit of moving the hub, we also have to consider the implication of primary freight cost from the manufacturing location. So in this case, as Indore was the manufacturing location, the distance between Pollachi and Indore was 1,637, and when it comes to Trichy, it was 1,690. So almost a kind of equidistance was there. But interestingly, when we look for freight rate, we observed that because of a better road network, at least the cost of serving Trichy was 90% of the cost which the company used to incur for Pollachi hub. So again, interestingly, this also gave one more significant reduction in cost, and a reason why company should really look for this alternative. So I think these were the very interesting notings that we could learn from one deep study with respect to the Polachi hub, which has its different kind of issues or problem. Now we come to the second hub. Now I think before I go to second hub, let me also understand from the organizer or team whether my sound is proper, whether you are able to hear me properly, because unfortunately in my area there is some program which is going on, so there is a background noise also. So if you are having some issue, please let me know, so that if I have to do some alternative arrangement, I will try to shift my room and try to see that whether we are having any issue or reduction in the noise level.
Sir, I am a student and there is no such background noise. You can continue.
Excellent. Thank you very much for that confirmation.
Welcome, sir.
Yeah. So we go to the next, I would say, hub, which is Vijayawada hub. Now, in this hub, the real issue was on the compliance. So as we have already discussed and deliberated that in 2014, Andhra was split into two states. Telangana came into picture. So this PA Care product had to restructure its compliance approach, especially for Vijayawada hub, because it is catering to all the location for both these states now. So before this split, there was a single tax registration and there was a unified reporting for both the states. However, post that cannot happen. Similarly, Vijayawada service dealer across the undivided region under one compliance framework. So that means the effort in doing various compliances is also very, very significantly less, because in the current scenario where we have two states catered by the same hub, we need to have two states compliance which add on the compliance from requirement very, very clearly. It is, if it is not double, at least it has a significant increase in the effort. Similarly, in addition to that, the earlier VAT was converted into GST, and that has also brought additional challenges of making them well compliant. So supplies to AP and Telangana must now be treated as interstate movement. As a student of GST, I'm sure you can easily correlate this situation. Similarly, the dual GST registration and the state-specific invoicing and the separate tax reporting is also an additional requirement. Similarly, the non-compliance has a very, very lethal impact, and those impacts are in the shape of delayed utilization of the input tax credit, and there would be a legal exposure also. And then as you know that GST authorities, whenever they find non-compliance, the obvious aspect comes in the form of penalties. So these were the exposure the organization was having at Vijayawada hub because of change of law and also the political or rather geopolitical kind of situation whereby a state is now split into two states. So these are very interestingly big shift for this location, and where not only they have to look for the compliance assurance, they also have to see that what tax implication it will bring, and hence those tax strategy comes into picture for us, and the entire distribution and compliance needs to be looked into mainly from the perspective of input tax credit utilization also. So as a student, you may be knowing very clearly that the GST has three categories: integrated GST, central GST, and state GST. And because of these two states distribution scenario, we need to see to it that how these credits are utilized to offset the liability which the organization is having. So this table is talking about one specific rule which I'm sure everybody would be knowing, that IGST ITC can be first offset against the IGST liability, then it can be offset against CGST, and then only in SGST. So when we are planning for these changes and compliances, we need to see that what impact it is going to have on these utilizations. Similarly, in the second line, we are talking about CGST ITC utilization. That first has to be adjusted against the liability, CGST liability, and then only you can go for IGST, and you cannot set off against SGST. Similarly, for SGST ITC, first it has to be offset against SGST liability and then only IGST liability. So these ITC claim utilization have to be very specifically looked into when we are giving a final solution on the Vijayawada C&F hub. Now, these strategic, financial and cost management analysis is very critical for us. And I think by now you must have understood the interesting complication as well as obvious changes which as a consultant we can provide. Now, I think from the financial management point of view, you have to appreciate one thing, that this company has historically followed a asset-light logistic model. That means they were not dependent, giving more reliance on their owning of fleet of vehicle and using for their logistic solution. What they used to do, they used to heavily depend on outsourcing, and hence the parcel services and the third party service vendor, that was more prevalent. So this is also one important aspect that comes in our strategic financial analysis. Similarly, you also have to understand one thing, that when we talk about use of vehicle, and if we compare it with parcel service is individual parcel to be given. So today in the scenario of Zomato and Swiggy, you can easily understand that every time parcel comes and we are through with that particular transaction. Now, this is not the case when it comes to use by a manufacturing company through a hub and spoke model, distribution model, to reach their dealer and retailer at various locations. We can rely on this outsourcing, then it will come with a cost. And using a truckload, mid to large load versus parcel is always costlier. So more than 30 to 40 costlier scenario exists in using this parcel service. So this is one good financial analysis which is needed to be done for Vijayawada hub. Why? Because there is an increased use of parcel services over a period of time. And hence, this costlier service has given an additional 70,000 rupees per month saving, provided they switch to their dedicated or leased truck, servicing. So this is one good, I would say, example by which financial management were demonstrated with the actual volume which the organization was handling. Similarly, one more thing that also can be understood is that when you are using the parcel services through outsourcing service provider, what kind of MIS they are generating and giving you? None. They are giving you bill and match to match, providing you the confirmation that yes, this material has been received by the ultimate receiver. Beyond that, how many kilometer, what time it has been taken, and various other related MIS and analysis is not possible. So that also data was missing, and hence from the cost management analysis point of view, this was very, very critical, and we ensured that we are providing a mechanism and framework for addressing data availability, and its analysis for better future strategic decision. So this was also another very interesting thing that has been done for Vijayawada hub. Similarly, in Pollachi, the outsourcing minimized maintenance cost, but it has resulted in inefficient trip scheduling, lack of control over kilometer driven, the minimal accountability for diesel efficiency. And hence, we gave finally our recommendation wherein the need for adopting hybrid transportation model was the need of hour. And it was suggested that you cannot replace with the parcel service with your own dedicated truck fully. However, for a low volume delivery locations, you can definitely look for parcel, because that becomes a very, very agile and cost efficient way, as against those locations where the delivery volumes are higher. So the moment we did those analysis, there was an obvious hybrid transportation model that came into picture, and it was taken a very, very cost efficient way for the organization. Similarly, with respect to the real-time tracking and cost control, the logistic roadmap need those data. So how to build that? So a MIS was designed whereby these variable parameters, which have a strategic importance on defining the kilometer run, the fuel cost incurred, the efficiency achieved, the utilization of truckload whenever we are utilizing it on a specific route specific costing. So various kind of next level MIS analysis for cost management was indicated. So students, you can see that the financial management as well as cost management has been imbibed in this particular case study, and it has a strategic significance because your decisions are very much hovering around these variables. So financial and cost management analysis was critical, and it was done relatively well through this study. For you, it is a case study, but it is a real case example which we have seen while serving one of our elite customer. Now, if you see how I can summarize the entire assignment, I think this slide is a very good way of presenting our ultimate analysis. So we as a service provider have done P-Care products C&F hubs in Pollachi and Vijayawada. This review or this analysis have revealed multiple governance and compliance gap in addition to the cost and financial management that we have discussed in an earlier page. So when we talk of governance and compliance, we found the following key issues. Number one, the parcel billing which was happening from Vijayawada, it was lacking the rate agreements, and that has led to inconsistent freight billing and poor trip level cost visibility. So a separate report have been given for the entire period under review, and it was an excellent, I would say, analysis that the management has considered for improvement, because it is having a direct hit on your cost reduction scenario. Similarly, for this particular hubs, the trip record, the mileage control, those were not visible. And nowadays, I'm sure you all know that the vehicles have the GPS tracking, and every vehicle is having a very good level of log maintenance, whereby the driver wise logbook and the route wise I would say GPS tracking, wherein the mileage and the time both are well tracked, and in addition, for each of the trip, how much fuel have been issued and how much it has been consumed, etc. So those trip record and mileage control related aspect were also not there, and that issue identification has also given a good classical picture to the management for good actions. Similarly, from the compliance point of view, there were GST compliance and documentation gap, whereby the errors in e-way bill generation and interstate stock transfer entries have been found by us. Similarly, there were inadequate segregation of invoices for dealer in both AP and Telangana, both the states. That has also increased the non-compliance risk. Similarly, with respect to the warehouse control, there were inadequate securities and insurance coverage. That has also raised operational vulnerability. I think this is very good, I would say, example that we have given to them, that while we were doing the reviews more focusing on the control and operational efficiency, but we have never off-guarded ourselves from looking into the related areas. So when we are doing the hubs, C&F hubs analysis, we have also touched upon the insurance risk management perspective, that whether this location where so much of stock is being stored and it is being distributed, whether the company has right kind of fire policies, various kind of transit policies of the right sub-insured level or not. So those kind of analysis have also been given to the management, and they were very happy and more insightful of taking cognizance of those deficiencies. So that operational vulnerability have been also identified and reported. Similarly, security related aspects have also been indicated, whereby the security contracts warrant that there would be X number of security personnel with these many conditions and qualifications. But when we looked into the actual deployment, we have found the other kind of scenario. So though it is having no direct relation to the problem that we are discussing, but in an overall context, the warehouse control has also been highlighted, and it was well appreciated. So I think all in all, at the end of the conclusion, I would say that this study has revealed various requirements for the organization, whereby the existing activities needs an automation, because those were manual in nature and not so efficient. Over a period of time, everything needs changes. So this manual activity need to be converted into automation. So automated control was one of the requirements. Similarly, the installation of GPS on the vehicle, which are used for logistic purpose, that was also highlighted and which was improved. Nowadays, it doesn't take that much of cost, because there are various service providers who are providing this GPS installed vehicle for transportation, and they also provide GPS to see that we in our truck or vehicles use those for various trip monitoring for timeliness and other related aspects. Similarly, the documentation of all these activities in a contemporary and dynamic SOP is also highlighted, because when an organization mature for certain number of years and the multiple people have come and gone, sometime the SOP which is made once, it is never updated and upgraded for various changes which are happening, and hence those aspects were also highlighted. We also highlighted the need for periodic reconciliation and the compliance assurance. So I think all in all, it was an excellent multidisciplinary approach oriented, I would say, assignment that we have rendered, and that assignment now offered to you as a case study. I'm sure you all must be enjoying the nitty-gritty, the minute details that we have deliberated on these two hubs, C&F hubs of a P-Care FMCG company. From all the angles, from the finance management, cost management, overall governance, the compliance. You see, we are talking about multifaceted review. I hope we are good to now go for scenario analysis. And I would be happy to see in chat your feedback, whether you have well understood the meticulous parameters for the case study and the various kind of diagnostic servicing that have been offered. So maybe any specific feedback in chat, that would be really highly appreciated. Sir, may I unmute and ask? Yes, please.
Sir, beautifully you explained, but I am having one query that since the Telangana and Andhra Pradesh was split during the year of 2014 and GST came in 2017. So how this went to the post split with regards to GST, because already VAT was there and separately in 2017 we need to take the registration in that respective state. So that shouldn't be a problem at all, right? So that is what I was thinking.
Yeah, right. I think in a normal scenario, what you say is absolutely fine, but I would put it like this: sometimes the issue get accumulated, and when there are other major issues which are to be addressed, sometimes these non-compliances, they creeps in and continued till somebody like service provider like us, or for that matter their in-house management, what you can say, higher ups come and diagnose those and then take corrective action. So in a way, in this case study, while you are right in saying, but in order to give a realistic perspective, this deficiency, which should have been ideally corrected, but that were continued, is also being indicated. So technically you are right, but for the sake of this case study, you assume that yes, it was a miss that could have been addressed earlier, but it was continued. And when this deep dive study was done for cost and finance and governance improvement, this compliance aspect were also highlighted, which could otherwise should have been undertaken.
Okay, so that means it is the old old problem which is continuing till
Absolutely.
date. That is the thing.
Absolutely,
Okay.
you are right. Absolutely, you are right. Yeah.
Yes, sir. Got it. Thank you.
So good. So now what we can do, we go back to our presentation, and we now see the scenarios. I think for the benefit, what we will do, we would have 3 scenario discussion, and each scenario would be posing you a question based on whatever we have discussed so far. And you please try to give the answer, so that we can appreciate and understand that yes, whatever has been taught is well understood. Yeah. So 3 scenarios would be discussed, and in addition to that, we would have I would say 5 multi-choice questions, just to see that we interact and we try to see some good solution to these questions. Right now, the first scenario is on strategic financial management. Now here, P-Care product C&F agents currently operate on a asset-light logistic model, relying on third-party vendors and parcel services for product delivery from its C&F hub. Now, a cost optimization process review at Vijayawada warehouse revealed that the use of parcel services for large volume route is adding 60 to 70,000 in a monthly avoidable cost. Now, the logistics team is now considering shifting to a hybrid model, where full truckload routes are managed through leased or semi-owned vehicle, while low volume dispatches continue through outsourcing channel. Now, the question is, what are the key financial implications of shifting from a fully outsourced model to a hybrid logistic model? number one. And second, how should PE Care product evaluate the return on investment for this transition? And what financial metrics should be considered? I think we have discussed this in some way while talking, but you can definitely try to indicate that what are the financial implications of shifting from a fully outsourcing model to a hybrid logistic model. Any take?
Like, sir, you are asking that the transition, sir?
Yes. So
Okay.
as indicated that the company is now trying to go for hybrid model, which is suggested by consultant like us. So what are the financial implications? Obvious financial implication. When fully outsourced model is transferred or converted to hybrid logistic model.
So, sir, as you also explained that when we are going for hybrid, that means for the high frequency routes, we are using our own leased or dedicated trucks. That will also save the high cost unavoidable of 60,000 to 70,000 savings. That financial implication to be considered, reduction in the cost. And for the low frequency areas, parcel services would be very well enough. So that means from fully outsourced, that excessive burden cost can be lowered by this hybrid logistics model.
Yes, I think you are definitely very near to this. But yes, I can just, further, I would say, make these financial implications so that you can understand well. Number one, the moment you go to a hybrid model, that means you are going to have your own vehicle. And the moment you have your own vehicle, there would be an initial capital outlay. Or if you are not buying with your own fund, obviously you go for lease. So again, there would be a leasing cost, which are a bigger sum that you have to pay at the initial. So this would be a cash flow impact which is going to happen. So initially there would be a higher capital outlay. However, as you rightly indicated, the per trip delivery cost would be substantially reduced and it would have a improved margin contribution per dispatch. So while there would be initial outlay, but as you rightly indicated, the per trip delivery cost would be reduced and hence there would be a margin contribution. Similarly, the control over mileage, fuel usage, and the trip scheduling will also lead to a long-term saving and predictability in freight spend. So mind you, students, please understand, we are talking about financial implication. So financial implication, you have to focus. So if this kind of question comes, which is quite obvious in these kind of case study, you must focus on the cash flow impact also. So initial outflow has interest cost associated to it or cost of return or so this is one thing. While you rightly said about the overall uses, per delivery cost would be reduced, the fuel usage, the trip rescheduling improvement would ensure that we are getting a saving over a period of time. But yes, fixed cost may increase, but cost per MT delivered would become more efficient on high frequency routes. So these were the financial implications that have to be considered. Now, if we talk about the second question, that what are the various financial metrics you would be using to evaluate the return on investment. So as you rightly know by now, since you are in final, that return on investment is always annual saving minus additional cost divided by your investment. So this is one matrix that we are going to use, this ratio. Similarly, there should be a comparison of cost per metric ton before the implementation and after the implementation, because then only you can very well say that yes, this is the outcome, whether it is benefiting in the right quantum or not. Similarly, as usual to these kind of study, we need to see what is the payback period for leasing or procurement of our own vehicle versus the outsourcing. Similarly, the break-even volume required to justify the additional fixed cost because of having our own transportation vehicle, though certain percentage, not fully, still that break-even volume requirement would be there. So that has also to be considered. And then key performance indicators like fuel efficiency, kilometer run per liter, similarly trip utilization in terms of percentage, cost to serve per stockist. I think these are other key performance indicator that we need to see. So these are the overall key evaluation metrics. Hope this scenario you have got it nicely. So these are the strategic financial management aspects that we have to consider. We go to the next scenario. The next scenario is on strategic cost management. Now the question is, the cost optimization review team at P-Care product Polachi Hub discovered that vehicles were frequently making multiple trips to the same stockist location, sometime within a gap of just 2 to 3 days only. In addition, the fleet comprises older trucks with poor fuel efficiency, that is hardly 4 to 6 km per liter. Now, this combined with the absence of route-based trip planning has led to a rise in logistic cost per metric ton, with the average delivery cost reaching 2,500 rupees per metric ton. Now, the management is considering implementation of a route clubbing strategy and investing in trip consolidation tool. Right? So route clubbing strategy and a trip consolidation tool, these are the strategic cost management aspect which the management is considering. So the question is, how can P-Care products focus on core route optimization and trip clustering contribute to strategic cost management? How can P-Care products focus on core route optimization and trip clustering, which contribute to strategic cost management? Secondly, what are the key cost-saving levers in shifting from fragmented trip to a structured dispatch model? So I think these are the strategic cost management scenario which is being there in front of the client. And now I think the answers are quite obvious. When we talk about the route optimization and trip clustering, the obvious benefit that we get is fuel consumption reduction, the driver hour reduction. This can minimize the and this is achieved by minimizing the empty returns and redundant trips. So I think this is one benefit which would be emerging out of route optimization and trip clustering. Similarly, it would lead to a better vehicle utilization and fewer trip per week per reason. It would also cut down maintenance cost and increases the asset lifespan for transport vehicle. Similarly, it would improve the load consolidation and it would increase the efficiency per delivery. So these are the benefit of route optimization and clustering. Similarly, the cost saving levers would be the fuel cost reduction through efficient routing and avoidance by duplicate, avoidance of duplicate deliveries. So there would be a fuel cost reduction. Similarly, lowered per unit logistic cost would be achieved by increasing the payload per trip. There would be a time-based savings on drivers' wages and reduced overnight halt. Possibility of negotiating better rates with the vendor due to planned volume dispatch. Similarly, reduce, the cost saving levers would be, it would reduce the stock outs or overstocking at stockist point due to better delivery predictability. I think these are the overall benefit that we are going to get through a structured dispatch planning, and then this will ensure logistics cost align closely with the sales volume and improve bottom line efficiency. So this is scenario 2 on strategic cost management. Now we go to the third scenario, which is on compliance and governance. Now, in this case study, you may get this kind of scenario analysis, and a question would be asked on that, which is directly impacting the compliance and governance. So, P-Care product operates a key C&F warehouse in Vijayawada, which prior to the bifurcation of Andhra Pradesh and Telangana, served dealers from both the states. Now, post GST implementation, dealers are required to maintain separate GST registration for each state. Obvious. Now, if they operate in multiple towns across state. However, during the cost optimization review, it was found that dispatches to Telangana based dealers locations were still being invoiced under Andhra Pradesh GST registration of the said dealer. Now, this created a mismatch in e-way bill generation and led to input tax credit reconciliation issue. Now, the question is, what are the risks of continuing dispatch without separate state-wise GST registration in a post-bifurcation environment? So, student, I think you asked a right question, that how it took so long time that they have not done this. But you please assume, and it is one of the interesting case that yes, there was a deficiency in their compliance, and this is a real scenario. So obviously, what is the key risk that the organization is exposed to when a continuous dispatch is being done without separate state-wise GST registration in a post-bifurcation environment? Similarly, how can P-Care products strengthen its internal compliance control to avoid such regulatory lapse? So I would like to now come to the students, if they can indicate there is one significant implication is there, and that risk, can you identify? Compliance risk is there, but then it also have a very, very significant financial impact also.
It
So
may
I
lead to heavy penalties.
heavy penalty, okay, fine, but heavy penalty is one thing, but what else?
Yes,
Very obvious.
the adjustments, ITC input tax credit adjustments. So your ITC would be blocked like anything. So that will be creating so much load on the working capital of the specific company.
Very good. I think, yes, you are spot on as far as this point is concerned. Good. So I think the biggest, as you rightly, indicated, penalty, that is very much there. And along with penalties, there would be a possibility of suspension of GSTN also. But I think one of the biggest aspect is that ITC denial to stockist in Telangana if the invoice are under the wrong state code. I think this is one of the biggest implication which is going to happen, because there are ITC reconciliation issues which are being surfaced because of this scenario, and hence these are very, very so-called significant risk which the organization is exposed to due to improper GST compliance. And similarly, now what are the obvious strengthening measure the organization has to have? It is to have two separate GST registration for the dealers locations in these two states. Similarly, integrate system to auto select the correct GSTN based on this stockist location, and accordingly correct state should be considered rather than the point which we discussed whereby wrong state was considered. Similarly, training to C&F agent on e-way bill generation protocol is also an important thing. I think initially everyone has gone through this particular issue. So the training to these agents are a must. Similarly, periodic internal audit and GST health check or compliance review should also be undertaken so that filing etc. are happening at right or what you can say time and with accuracy. So a compliance first approach protects P-Care product from legal risk while reinforcing its credibility with the regulators, and business partners. So I think these are the three scenario analysis that we have done. Now it's time for MCQ. And and these are good to score. And I'm sure by now, the way we have gone into the nitty-gritty and meticulous understanding, I'm sure this is easy to come in. So I would seek your feedback. First question, PK product cost optimization review team found that parcel deliveries from Vijayawada hub cost 2,200 per metric ton, whereas full truckload delivery in the same route cost 1,600 per metric ton. So now you see parcel delivery versus full truckload. Now the hub dispatches 100 metric ton per month on this route. What is the estimated monthly avoidable cost due to parcel service uses? Very easy. May I know?
Yeah, it's 60,000.
Absolutely. I think all would be perfectly fine on this. Yes. Now let's go to the second question. After the Andhra Telangana split, P-Care product continued dispatching to Telangana-based dealers using their Andhra Pradesh GSTIN from Vijayawada. Which of the following best explain the compliance risk? Number one, dual GSTIN not needed for state for the same dealer. ITC claim by Telangana dealers may be denied. E-way bill auto adjustment based on delivery location, and centralized invoicing overrides state-wise registration.
Sir, option B, sir. ITC claims by Telangana dealer may be denied.
Absolutely correct. Good. Similarly, now Polachi C&F uses old truck averaging 5 km per liter. A proposed shift to new truck improves mileage to 8 km per liter. For a 240 km trip with 50 liters fuel currently consumed, how much fuel saving per trip would the new truck offer? Yes, you need to do some calculation before giving me the right option. So I'm waiting for another 20 seconds to see who comes with the answer. Ten, 6, 3, 0. Oh my goodness. I think we are taking little more time. The answer is 18 liters. See, you can see the old fuel needed 240 divided by 5. So that means 48 liter. The new fuel need is of 30 liter. How? 240 divided by 8. So that means the difference between the old and new is 18 liters. So fuel saving per trip. I hope this is clear.
Yes, sir. Actually, I did mistake in computation. That's why.
Yes. No, in fact, the question is there like that only to make interesting mistakes. Okay. Because 50 liter is something which is going to give a botheration. Rest is absolutely fine. Okay, now let's see this fourth question. P-Care product is exploring a hybrid logistics model with leased truck for high frequency routes and parcel services for low volume area. This decision primarily reflects what? A marketing strategy for regional expansion, a backward integration into logistics, a cost leadership approach through supply chain design, or a focus on product innovation.
Sir, I think it is a cost leadership approach for supply chain design as we reduce the cost by using laser trucks for high frequency routes.
Absolutely fine. Absolutely fine. Good. So as long as calculation are not there, I think our strategic approach and everything is excellent. It is very quick. I'm happy to see this. Yeah. But again, I will come back to this calculation. So I'm not going to leave you guys. Please now do a good calculation. This time we have to come with correct answer. So Polachi service dealer in Tanjore, which is closer to Trichy. Now, by shifting the C&F hub to Trichy, peak air products could save 25 kilometers per trip on a 50 trip per month. Now, if the diesel cost is rupees 90 per liter and truck average is 6 kilometer per liter, how much could be saved monthly? I think I would give almost 40 seconds. Let me just take the clock. Yeah.
Sir, it is B, 18,750.
Excellent. I'm so happy. I could really see that this time we are not taking time to answer. So you are absolutely right. So it is 25 kilometer into 51 to 50 kilometer on a distance saved, and considering the fuel saved, which is around 208.33 liters, the saving would be 18750. Okay, cool. I think with this we have concluded our first case study. And I think before we go to case study 2, if you have any further point to deliberate, we can discuss. Otherwise, we will wait for 5 minutes. I will not take more time, I think, and I would also provide 5 minutes break to you guys also. Do whatever you want to do. The second case study would be more interesting, and it is not restricted to Indian client. It is reaching to the overseas client. So I'm sure you would really enjoy that study as well. So before we go for a break, if you have any question on this case study, you are welcome. Otherwise, 5-minute break, and then we will resume on our second case study.
Sir, I was thinking that since you worked upon this assignment, like what made them, depend heavily on the parcel services with regards to logistics, because it was clearly apparent that it was causing a huge financial burden on them.
Yeah, see, you have to appreciate one thing, that in the overall context, whenever you have multi-disciplinary, or rather I would say multi-locational servicing, inefficiency breed at certain locations. And it is also a classic case that you are relying on people, process, or technology for any activity or control. Now, this company, which is our client, now it was having a legacy. So when you have a legacy, you are inheriting inefficiencies also. So over a period of time, though it appears to be very simple and easy to pick, but unless you focus and come out with these kind of observation, the top management who is looking at a very big picture, pan-India picture, company level picture, probably sometime you don't end up in detecting this. And hence, such a obvious thing was in legacy and it was carried on. And in the overall context, the company was earning money, so it has not bothered. But the moment it started signs of cost increase, fuel cost increase from external environment, plus there were certain reconciliation issue that has come from ITC, they started really looking into much botheration, and the fact that there were split of this state, and that pain was adding. We came at the right time to really give a detailed study analysis and then come out and give them the obvious easy pick or low hanging fruits to be addressed also, in addition to doing a deep down analysis. So this was the overall reason or scenario I can share with you.
Yeah, they were blinded by the legacy, but then eventually, when the burden, hit them hard, so they started looking into the minor nitty gritties. That's what we can take.
Yes,
Okay, sir.
yeah.
Thank you.
In fact, I also recall a similar cost reduction exercise have been done by us in Muscat, wherein the company was having a regular reduction or squeeze on their profitability. So the assignment was absolutely on how to increase profitability. Excellent, I would say, study. Normally, these kind of studies are done by big time consulting firms like McKinsey's and Boston Group and all those big. But then yes, their cost also is very high. So obviously, you always end up in having mid and small size client to ask for these kind of study from a normal CA firm with a consulting vertical. So there also, the moment you start looking into the profitability in case increase assignment, you have to have multi-pronged approach, various areas, direct, indirect, cost related aspect, the revenue related aspect, assets and liability, control, everything comes into picture. So that gives you a multidisciplinary functional approach in the best possible way. So integrated business solution or servicing can be given best in these kind of assignment. And I think this also was a very focused cost reduction exercise that we have done. Though that Muscatwala was having a full-blown organization-wide, what you can say, assignment, where the integrated business solution was given, which is the topic which we are dealing with today. And this subject is really making chartered accountants a very, very good value adding consultant or service provider.
Yes, sir, indeed. I think that we not only being the CA, we also would be requiring so much expert evaluations also. That's what I was thinking about this.
Yes, and Radha, I would put it like this, that in the current scenario, it becomes more easier to be a great journalist. Why? Because specialization would come through various sources, including not only your technical and theoretical knowledge, but also your experience, plus the new age AI tools that is also provide you the best of the specialization that you can get from them. But then ultimately, you have to have ownership and right direction has to be given for using these technologies and experience. But yes, it is a big ticket, highly remunerating assignment, and highly rewarding and value-adding assignment that we can provide and give to us, to client, and to our firm.
Thank you, sir.
Welcome. So with this, we take exactly 5 minutes break. Now it is 2018. So maybe we will come by 2025. I don't know whether we are talking the same time or what. 2018. So now we will reassemble at 2025, exactly 6 minutes from now. Yeah.
Yeah, sir. Okay.
Okay. Thanks. Yes. Hi, good evening once again. I hope all are there for the second case study. Can anyone confirm either in chat?
Yes, sir. Excited.
Okay, great. So welcome back. Right. So as I told you, the second case study is more interesting. When I say more interesting, it doesn't mean that first was not. I'm sure you all have enjoyed that. But why it is interesting? Why? Because it is a new international foray case study whereby one of our client, that is Golden Grain, they are trying to look for going and having their new business launch, which is nothing but a health focused food processing venture in Kenya. So this company is launching this venture in Kenya, and they are aiming at producing nutritious cereal bar for wellness conscious consumer across East Africa. Why Kenya? Obviously, there is always a strategic reason. So here, the reason is it's a strategic trade location with improving industrial infrastructure. Secondly, government support for agro processing units. Third, rising demand from healthy, affordable snacks driven by urbanization and lifestyle shifts. So the case study evaluates business model and scalability. It considers or evaluate capital investment and cost structure. It talk about profitability outlook, the export potential, and it also consider the supply chain sourcing and compliance risk in emerging market. So as we are talking about company going in Kenya with a new venture and having a kind of wellness industries connect. So their overall objective is that they aim to position itself as a trusted, affordable wellness brand in both local as well as regional market. So with this, the basic introduction of Golden Grain Kenya project company is done. Now we come to more better discussion on the business model and the core operation, because now this is very important, students. You have to appreciate one thing, that whatever we do, we are doing it for the client, and client has a business or a profession, and every business and profession has a business model and core operations. So we need to understand that this overseas project, what is the business model and what are the core operations. So Golden Grain Kenya runs a semi-automated cereal bar plant near Nairobi, structured for both efficiency and flexibility. So the operational flow is like this. The raw material intake is coming, and batch wise there is a baking, and once the bar is baked, produced, the packaging is done, and then dispatch happens. So it's a very simple operational flow. Though if you go into the next level of granular level analysis, you will find that every single word mentioned here has a huge second, third, and fourth layers or levels of detailing. But yes, on a holistic and macro level, this is the overall thing. Take the raw material, make batch wise various operations, including the baking, which is the most important, I would say, activity. And then once the product is baked, packaging and dispatch out. Now, what are the key features of this operation? So it's a 12 plus metric ton per day capacity across 8 plus health focused SKUs. SKUs, I hope you understand, it is stock keeping units. So 8 plus different type of SKUs are there here. So we are talking about high fiber, protein, and low sugar bars, which is considered as its SKU. So there are 8 plus different type of SKUs. Those are health focused bars. Now, what are the ingredients? So ingredients are local grains and nuts. That is the most important. Plus selective import of some chemicals, and those are used for improving the shelf life of the bar. Then, of course, along with that, some nutritions are also being imported. So the key ingredients is local grain and nuts. And in order to preserve the shelf life, some chemicals and nutritions are being imported, and those are used. So these are the key ingredients. And on-site packaging happen for maintaining the freshness and brand consistency. So it is a flow, wrap, or pillow pack. So either of the packaging, it is there. So this is the overall, I would say, key features. Now, when we talk about the distribution strategy, primary transport outsourced. That is, primary transport is outsourced and last mile delivery handled in-house. So that means from the plant to various key hubs or distribution center, this route is outsourced. So third parties vendors are being used. However, from that warehouse to the ultimate retailers and consumer, it is the in-house last mile delivery mechanism is being adopted. Now here, asset-light warehousing via third-party storage is in practice. So this is also another important aspect of the distribution strategy. The export lines handled by contract packer to maintain scalability. So I think when it comes to domestic, probably we have in-house packers, but then when it comes to export line, in view of various stringent quality and other requirement, it is handled by contract packers, and this also helps them for scaling up their operation. So scalability is another driving force for this kind of their distribution strategy. Now, Golden Grains model ensures cost efficiency, product diversity, and export readiness backed by smart sourcing and lean logistics. I hope this business model and core operation is well understood, and it is giving a very picture perfect, theoretically best scenario to really look for. Now we go deep dive in the company's background and vision also, so that we can appreciate it better, and we becomes engrossed in this case study further. Now here, Golden Grain Kenya was founded in 2022 by second generation entrepreneurs and food industry veterans, backed by Savannah Roots Capital, an African focused VC fund. So that means very good experienced entrepreneur coupled with big pocket VC funding. So this is the hallmark of a great organization. So they are into it. And the founding team brings deep experience in FMCG, agri supply chains, and nutraceuticals, aiming to serve the growing demand for nutritious, affordable snacks across East Africa. Now, this is a very noble kind of scenario that we are seeing. But yes, this is very much achievable. Why Kenya? Again, we discussed earlier also. Kenya is a strategic trade hub with rising disposable income. Their government is very much supportive of providing the business-friendly environment. So they are providing incentives. Like in India, we have some interesting incentives in practice, like PLI, product link incentives. Similarly, their government is also providing incentive under the Big Four agenda, whereby land, tax, and machinery benefits are provided. Like any other government, this is also progressive government for that matter, and strong middle class, stable governance, and improving infrastructure. So these are the reason why Kenya was selected by the entrepreneur. Then there is a long-term vision which the company has. They want to become East Africa's most trusted health snack brand. Similarly, their long-term vision is to focus on cereal-based wellness product for urban youth and families. So similarly, they also have a vision to expand into COMESA and GCC export markets in and around Africa via high compliance production facility. So I think these long-term visions are again noble. I'm sure you can easily correlate, like in India, we can have a parallel in the name of, say, Nestle. It's a very reputed brand, and came to India in a similar situation only. Now here, Indian company going to Kenya and trying to see a vision whereby they are focusing on the entire African region over a period of time. So I think the long-term vision is highly credible again, and the core mission is, however, to deliver nutrition, affordable, and sustainability all in one bar. It's very interesting core mission. So this is the overall background and vision. We can talk of this company. Now, what are the strategic decision making? Now, this golden grains Kenya setup reflects carefully balanced decisions across capacity, cost, market strategy. In terms of production capacity, they are designed for 12 plus metric ton per day, and it supports multi-SKU portfolio. Please understand these highlighted words, because this is going to help you. And when you are talking about the integrated business solutions and servicing and strategies, these are very, very pertinent, because you are looking from all the angles. So production design, capacity utilization, multi-SKU portfolio, then the scale aligned with the retail demand forecasts, and also break-even analysis. So these strategic management and finance management and cost management angles are now creeping in. Similarly, sourcing strategy is that local sourcing of oat millets to reduce cost, and import from UAE and South Africa for nutrients and flavor compound, which ensures not only the quality but also the shelf life, and then there is a cost balance as well. So I think overall the sourcing strategy is also very interesting. So in addition to production capacity, sourcing strategy, the pricing and margin is also very nicely capturing 30 to 35% of gross margin, because the overall pricing model is cost plus pricing. When we talk of entry level SKU priced for urban retail penetration, it is always at a lower end, but yes, this is the strategy that they are looking for. In addition, export grade variant, these are aligned to international healthy snake price point. So that means the cost plus pricing model that we are talking about, with a targeted 30 to 35% gross margin, in case of export, they are not going by this. They are going by comparative analysis of internationally healthy snake bar price point. So yes, very interesting pricing strategy the organization is talking about. At local level, it is cost plus pricing, but in case of international, it is comparative stock, rather I would say, price, snake price, which they are looking for. Now, in terms of capital planning, the 1.8 million of capex, US dollar capex, that would cover the machinery, the utilities, and the food grade level infrastructure that is required. Now, the investment structure designed to support scale, efficiency, and investor interest. These strategic choices set a strong foundation for sustainable growth, scalability, and cross-border market entry. So I think these are very interesting strategic decision making which are seen in this overseas venture. So while we have seen a very interesting angle of the positives, risk management and challenges creeps in, because everything and anything we have to see from the lens of SWOT analysis. Every project, every business has its strength, opportunity, weakness, and threat. So we have to look for these aspects. So here, if you see this, project, there are certain key challenges and risks. So operating in Kenya, this company faces several strategic and operational risks. Now that impacts cost, compliance, and profitability. Number one, there is a currency risk. Because this company is going to import various flavor enhancer and some packaging and additives, they are importing these materials, and these material import would be vulnerable to Kenyan shilling depreciation, because the currency of Kenya is Kenyan shilling, and this Kenyan shilling is exposed to a risk of depreciation. Third world countries like African nation and Kenya truly represent them. In India also in past and now also, the rupee depreciation, it is talk of the town, everybody knows. So this is the most realistic currency risk that this project is exposed to. Similarly, import, it increases landed cost and squeezes, but anyway, I think what we are trying to talk about is that currency risk is one of the biggest risks when it comes to this particular project, because of the depreciation of the local currency against the US dollar or other currency. And obviously, import is always in foreign currency, so the landed cost increase. The moment landed cost increase, your margin would be squeezed. So that margin which we are talking about 30 to 35%, suddenly you will find that it is less than in 2 digit. It's in single digit only. So that's the biggest risk. Similarly, energy and utilities, with respect to these risks, fuel and electricity price are volatile due to import dependency. This country is highly dependent on fuel like India, and hence the electricity and fuel cost is directly related to that, and accordingly the volatility in the prices of fuel and electricity is the real challenge. Similarly, the energy intensive processes are there for this company, because it involves various processes like baking, cooling, and storage, which is high energy intensive processes. And hence, this is the second biggest risk this project is having. Then coming to skilled manpower resource in Kenya, again, there is a shortage or dearth of such resources. Scarcity of trained staff for food safety, quality control, and packaging is the real challenge. Similarly, the management definitely have tried to look for mitigation of this particular risk by having a strong training program and to have a semi-automation lines. So I think there is a mitigation for this risk that has been identified, which has been listed here. Similarly, there is a regulatory uncertainty. The risk from shifts in import duty, VAT, and labeling laws, that is going to have an impact. Every regulatory uncertainty increases the risk of doing business in any country to the next level. So this food related stuff, nutrition bar, is also subject to the regulatory uncertainty. Similarly, it requires continuous policy monitoring and compliance update. So unless you have the best of these mitigation, this risk could be really daunting. Similarly, we have already spoken on the currency risk and energy and utility, but overall rising inflation and logistic cost is also another big challenge for the price stability of this project. And to mitigate this, it calls for frequent pricing revalidation to protect the margin. So again, this is not so easy to do. So these are the real-time challenges which any food and food processing industry would be exposed to, and particularly when it comes to going to a third world country like Kenya, which has a strategic advantage, but at the same time, these challenges and risks are real and very, very stringent and at a very, very significant level. And hence, the success of this project is depending on active risk management, cost control, and being agile for changing their strategy. So strategic flexibility is required in this country that is dynamic emerging market. I hope this is clear. So challenges and risk have also been discussed. So it's very nice to see that, we have now gone in depth of this project. We have now known good nuances. So now let's talk about projected financial performance, because every project, you need to have a clarity on the financial numbers. So Golden Grain Kenya is forecasted to achieve steady financial growth over the first 5 to 7 years of operations. The revenue growth and break-even is targeted like this. There would be a gradual revenue build-up starting from year 1. Break-even would be achieved by year 3, where the SKUs and retail channel would be scaled up, and growth driven by volume expansion and multi-market reach. So this is the overall growth, revenue growth and break-even that has been forecasted. Similarly, on the profitability, the EBITDA margin projected to stabilize at 18 to 20% by year 4, and PAT turns positive by year 2 as the setup cost and depreciation taper off in the wake of volume expansion and multi-market reach. So ultimately, fixed cost optimized through higher production volume. That's the mantra for profitability. That's the only way. If we have any impact on that, gone. The entire forecast will go for a toss. Now, for cash flow and balance sheet, a strong working capital cycle by year 3 would emerge. Controlled receivable and efficiency inventory turnover would be the highlight to achieve this. And there would be a healthy equity to debt ratio with limited borrowings. There would be increasing retained earnings support, which would be supporting the reinvestment. And hence, in all, conclusion is that Golden Grain is financially structured for scalable growth, margin discipline, and long-term sustainability, which reinforcing its credibility in the East Africa's wellness food sector. Now, from the cost structure and unit economics, Golden Grains Kenya follow a lean costing module whereby the local sourcing is balanced, the overheads are controlled, and variable costs, costs are scalable. As the revenue grow, variable cost is directly associated with. So it's a very lean costing model that they are following. The per unit cost breakdown is like this. Around 55 to 60% is towards raw material and packaging cost. So oat, millets, wrappers, flavor bases, etc. that would account for 55 to 60. And there would be 5 to 8% labor and utilities cost, for the obvious reason that for baking, cooling, packaging, etc., you would need labor as well as you would need electricity. So utility cost, etc., will creep in. So around, you can say 60 to 68% are towards these variable cost. Then remaining percentage, I would say overhead, there would be a QC, admin, management and selling expenses that would also be there for per unit cost breakdown. Now, the contribution, the target is 40 to 45%. Though in the initial period, you can see that it is coming to around what 32 to 40%. But then target is 40 to 45%, and that too depending on SKU type. Premium variant, there would be higher margin and ingredient cost, higher ingredient cost. In economy SKU, there would be a tighter pricing for mass market reach, and for scalability and margin control, higher sales volume improves the fixed cost absorption, obviously, and margin projected to strengthen over next 3 to 5 years. The ongoing cost tracking and supply negotiation is essential to maintain profitability. Golden Grains cost model is built for volume-based efficiency while preserving the flexibility across market and product lines. So this is the overall cost structure and unit economics. Now we come to capital investment and funding structure. The Golden Grain Kenya setup was backed by a balanced funding mix of equity and long-term debt. The total capex is 1.8 million, which cater to machinery, utility, site, packaging lines, and working capital. The funding split is 60% equity and 40% debt. As we indicated, the promoter and Savannah Root Capital, the VC, would be bringing 60% equity and 40% would be a term loan from a development financial institute. This would be a 7-year repayment loan, 24 months principal moratorium. So initial period would be, there would be a cash flow relief that would be there. Now, capex allocation would be that 35% would be towards production machinery, 25% would be building and infrastructure, and 15% is all utilities, power and water. Balance would be for packaging automation, pre-operative cost, etc. Now, what is the loan strategy and return? Repayment aligned with the projected EBITDA ramp up, and tax and depreciation benefit leveraged under Kenya's agro processing schemes, and the target is positive return on capital by year 4. This funding structure supports scalability, protect early cash flow, and align the Golden Grain's long-term financial strategy. Sorry. Now we go to the profitability and return metrics. Now here, Golden Grain's Kenya financial model reflects a scalable variable investment with healthy return indicator. Now, what are the key metrics? First is IRR is 16.19% over 10 years. Debt servicing coverage ratio is more than 2 across projection period, which is very good. Similarly, break even is in 3rd year. Payback period is 5.31 year. Return on investment in year 3 is around 22%. Return on capital, ROC is around 15%. Capital employed is 15%. So it would be sustained in later year. So I think this is a very healthy ROC, even in what you can say, share market also study. Whenever you are looking for a very good opportunity of investment, you always look for what is the ROC of the organization. Anything less than 10% is obviously not a relevant for investment in terms of better return. But yes, 15% and above is a healthy aspect. So this is what is going to be sustained for this business. And from the sensitivity analysis, when we did the forecasting, etc., we have considered a sensitivity analysis for 5% price drop, 5% price increase. And in both this scenario, in case of drop, the IRR falls to 9.87 and it significantly impact the PAT. Similarly, for 5% increase, IRR raises to 22.56, which is nearly doubling the year 3 profit. Now, omission of SKUs, for example, digestives. So IRR drops to 3.58%, project viability weakens. So the moment we look for omitting certain SKU like digestives, the IRR dramatically drops to 3.58. So that means this entire project has a very important aspect that you cannot omit SKU like digestive. But then when we are doing the sensitivity analysis, we have to consider those. So we have considered that, which brings very dangerous situation, which weakens the project viability. That if you omit certain SKUs like digestives, gone. Right. So what is the insight? Insight is product mix discipline, price control, and raw material cost optimizations are key to maintaining profitability. Financial resilience is built on volume scalability and margin protection. Golden Grain's model offers strong returns but demands tight cost and SKU management to stay viable. I hope this profitability and return metrics gives a very good picture. Now we come to the scenario analysis. So now again we would have 3 scenario discussion and 5 multiple choice questions. So I hope all are geared up for that. So let me just ask whether we have got to understand the project clearer, or we need to have a deliberation before we go to the scenario analysis discussion. If you are okay, you can type yes, so that I can understand that yes, you have understood the nitty-gritty of this project reasonably well.
I was pondering upon the IRR decline due to the digestives. What was that point specifically? Why it declined?
Yeah, so see, as we discussed in our indication earlier, that the organization would be having multi-SKU portfolio in it. Now, SKU is stock keeping unit. So that means they are going for a wellness bar. Now, these bar would be of 8 plus different kind. Now, one of the kind is digestive. See, today, digestive segment is very, very lucrative, because typically when a middle class or high net worth individual or some affluent population, when they start looking after their health, the first thing that comes is various kind of wellness product, particularly the digestive, etc. It goes in increasing demand, and since the contribution is highest here, so we have tried to do a sensitivity analysis whereby out of the 8 different SKU, we took out the highest contributing SKU out of it. So it was the digestive. The moment we take it out, omitted in our sensitivity analysis, the project is not giving a desired IRR, and it is as low as less than 3%, and accordingly it is questioning the viability of the project. So it's an analysis that was done in forecasting.
Yes,
And
sir, got it.
normally forecasting is done, sensitivity analysis is done like this only. You drop the price by 5%, increase by 5%, you omit certain SKU portfolio like this. So it's a and why you are deleting it? Because there is a reason. The reason is that this one SKU has the maximum contribution coming to you. So obviously, if we see a situation that if this SKU is not there in your portfolio, then what would be the project look like? The IRR drops significantly less. So it's a sensitivity analysis wherein this kind of things do come.
Yes, sir.
Yeah.
That means because one of the SKU was being overlooked by the golden grain. That is the main point.
No, you can't say that overlook. It is in the game of their project. They know that the wellness bar which they are making, primarily it is targeting the mass where the contribution would be less, but it is also catering to the affluent population plus export market where the profitability is highest. So digestive bar was having the highest profitability, and it was indicated that it would be taken for the export purposes also, and even in domestic area, these digestive would be provided for affluent population, not the masses. So it was one of the business assumptions with which these people have gone, the promoter have gone, and it is rightly so, because you can always find every kind of organization which is catering to different market segment and customers. So export market and affluent population is one of the target customers in this case. So we try to just sensitize by doing this sensitivity analysis, that if you happen to have this SKU omitted for any reason, like for example the line did not work, the quality did not come properly, or what else. So the moment we do that, it is giving a scary picture. So obviously, as a management consultant, as a financial forecaster, you need to have those various scenario analysis or sensitivity analysis done to give a best picture. And in fact, when you approach the financial institute, they do ask for it. Okay, where is your project report? Where is your projections? In the projections, what kind of sensitivity analysis you have done? So these are the obvious questions.
Yeah, that means the volatility is being considered over that specific sector of SQ, right? Am I getting it correct?
Maybe I would say that to some extent, yes, the higher contribution, the moment you ignore it from the calculation, the entire projection goes volatile. So in that sense, yes, you are right. However, promoter have a wisdom. The venture capital funding agency definitely have wisdom to see whether whatever higher margin they are considering for these digestives, whether it would meet its customer the way they are projecting. So we have to respect or view from that point of view also. See, this is one point that has triggered this situation, but whether it is going to happen is always a question mark. No? So you can have various kind of sensitivity analysis wherein you can say that this project is useless, but it doesn't make that project useless. It is just giving a scenario analysis so that you can have your alternative different, you can say reasoning and action plan also. Because if there is a great belief in the project at this planning stage, it is always better to do various scenario analysis, and this is called the risk management. In risk management also, we are doing various kind of assumptions and scenario analysis, and you always consider worst case situation. And the moment you consider worst case situation, then how to react. So probably this is worst case situation forecasting which has been considered while doing the analysis.
Clear, sir. Absolutely clear.
Yeah. Okay.
Sir, one
Yeah.
more thing, sir.
Yeah.
Sir, as we see the capital expenditure of 1.8 million of US dollars, sir, instead of putting one like in that 1.8 million dollars, they are almost 35% has been dedicated to for missionary.
Right.
And in prior like in starting of case study, you have mentioned that the Kenya government has uh, under the scheme of Big Four agenda, they are providing the missionary benefits. Why
Right.
can't without before taking these investments? Why can't Golden Green Kenya use the government incentive for taking missionary, sir?
Yeah. Okay.
For purchasing missionary.
Yeah. Good question. So let me first drink water before I answer this.
Yeah.
See, you have asked a very good question. But do you feel that government would be so easy to provide you money? Whether it is Kenya or India, it is not like this. They would always ask you to first put your money, and then you will get some incentive in the form of exemption of GST, return of custom duty after some point of time. Initially, you have to spend only. So it is always like this, that when you are projecting for initial investment, the relief from government doesn't come like this. However, for example, government normally gives GST exemption to the extent of machinery value. Rather than funding you the machinery cost, they would give you benefit like this. So you have to now understand the manner in which benefit from government has received. So in your example, in your question, you asked that why can't we use government schemes money while projecting this? No, it doesn't happen that way. It is always the other form of benefit which government gives, and for that initially you have to spend. So this capex is most likely happens upfront with the help of equity and debt contribution only, and then since government is having a very good scheme, they provide you various benefits including return of certain portion of machinery cost in way of GST liability set off, income tax set off, or some subsidy which may be received once you start making operations, and some exports which are happening. So there are so many terms and conditions which government puts. Upfront, you will not get it. Okay. In India, I can only give one example. For example, when you are buying electric vehicle, for example, the government is funding you some X amount of money. Probably this is one thing where your cost automatically reduce from your pocket. You are giving certain value of the vehicle which is definitely lesser than the market value. Why? Because government is directly paying to the dealer who is selling the vehicle. So that is one classical example where your point can be considered. But for this project, that kind of rebate upfront funding is not received from government, and hence it is not considered.
Sir, ultimately, I can add upon this. See, a specific or project needs a basic investment. Capex is very essential. If you're making specific investment, then only government can provide for it. That can be also one scenario. And if you want the advanced funding, then of course the Savannah Roots Capital is obviously supporting in that venture. So ultimately, that funds is also being invested into this project.
Absolutely correct. Yes, but yes, they are coming as an investor. Obviously, yes. Government normally doesn't come, and hence the question which is asked by another student is mainly on the rebate and can say benefit which we are getting from government. So I'm just giving a perspective that typically you don't get upfront funding the way Savannah Root Capital has given, like they are participating in equity, or some financial institute are providing the debt, the term loan. Government doesn't give that. It gives benefit which you would reap in later on only, but initially for these machinery, etc., you have to spend only. Yeah.
Yeah, sir. Okay, thank you.
So now we go to the first scenario discussion. GG Kenya is considering an expansion of its production capacity by year 3 through the installation of a second high-speed packaging line. This investment, estimated at around 700,000 US dollar, is expected to boost export capacity and result in a 50% increase in annual revenue starting from year 4. However, this move would require new funding, obviously. Now, the company currently maintains a healthy DSCR at 2 plus and the projected IRR of 16.19 with ROCE expected to stabilize at around 15% from year 3. Now, with this background, the management is now debating whether, or between two opportunities, so two alternatives, whether to raise new debt for funding this expansion or diluting promoters' equity to fund this expansion. So the obvious question is, should GG Kenya opt for debt or equity funding considering its existing loan repayment obligation and DSCR? Second question, how might this decision impact IRR, ROCE, and the company's long-term financial risk profile? So it's a very interesting question, very obvious question. We have talked of initial 1.8 million and all those stuff, but now in year 3 we are talking about expansion. So given the understanding of the project so far, what is the basic aspect you would suggest on these two alternatives, whether they should opt for debt or equity funding? Yes.
I see, sir. Computation, with regards to computation, I'm not going into it because I'm not aware of that. But on the general perception, I think that since it is having a healthy DSCR, then it can go for certain proportion of new debt, and it can follow a hybrid structure of debt as well as the equity. So it will balance it in a very good way, because you also need certain equity fundings also to keep the the project ongoing in a well mannered way. So that's what my perception is.
So probably hybrid may not be the right approach here. You have to choose between the alternative because the question is very clear whether they should opt for debt or equity funding. No hybrid third alternative.
Since it is already into 60-40 ratio, already it is having that debt and equity ratio.
Right.
I think that it can, like, if it further increases the debt, then it will overburden, I guess. Because already 60% of the debt is already there. So it can go into the edge of equity funding in that case, as So that's why observation speaks about it.
Okay, so you are now tilting your final conclusion towards equity funding dilution, equity dilution.
Yes, yes.
Okay. Who else can attempt? Very interesting. In fact, again, I will go back. So here is the overall situation: 1.8 million initial capex. This is the and yeah, here it is. No.
No, it went ahead, I guess.
Yeah, this.
Okay, sorry. It is 60 equity and 40 debt. Okay, I thought it's 60 debt and 40 equity. Okay. Then the data goes reverse, sir. Then though it can take chance in debt, to be frank.
Yes, now you are coming to the point. Okay, great. So I think, let's try to, look into the reasoning. You are rightly now coming to the debt funding. So given the strong DSCR and manageable current debt, opting for debt funding may preserve promoter control and improve ROCE if the return from the new line exceeds the borrowing cost. However, the caveat is increasing debt will raise fixed interest commitment, slightly lowering the IRR in short term. There would be equity dilution, while safer for cash flow, may reduce overall shareholders' return. Strategically, if revenue visibility from export is strong, debt may offer better financial leverage and capital efficiency. Right? So I think we now have cracked the answer in scenario 1. Good.
But the taxability provisions, I am not aware in the Kenya. So I think that would be also savings, right, sir? As per the further
Yes,
opinion.
absolutely. Yes, you are right.
Yes.
Good.
Okay, sir.
Now, coming to scenario 2, strategic cost management. The operations team at GG Kenya observed inefficiencies in raw material procurement and SKU level production scheduling. The company currently sources wheat flour and key additives through monthly import, but fluctuating global prices have caused material cost volatility, impacting contribution margins. The recent sensitivity analysis revealed that a 5% increase in the material cost reduces IRR from 16.19% to 12.4%, while a 5% decline in selling price drops IRR further to 9.87%, drastically affecting profitability. To stabilize cost, management is evaluating two options: entering into long-term contract with supplier to lock in pricing. Secondly, rationalizing low margin SKUs and focusing on higher margin variants with better volume traction. Now the question is, how can GG Kenya apply strategic cost management to maintain IRR and contribution margin in the face of material price inflation? So very interesting, no? Because they are trying to see that to stabilize cost, we should try to enter into a long-term contract with supplier to lock in price. So how can GG Kenya apply strategic cost management to maintain IRR and contribution margin in the face of material price inflation?
There are various ways. So first thing, of course, long-term contracts would be helping out irrespective of the fluctuation. But there are also demerits if the price, the inflationary situation is curbed. So it depends on the first aspect. The second aspect is definitely the hedging option, sir, would be valid, right? That's I'm just asking. Maybe it can do the hedging contracts and then it can, severe the impact of the material cost inflationary position.
You are absolutely right. I think hedging is one of the very good option to counter the increase in pricing. Yes, you are perfectly, right in this. Though it is not mentioned here, but I think your perspective is absolutely correct. So depending on the cost of hedge, yes, this is very, very, pertinent. And there is a danger also, like entering into a long-term contract with the supplier to lock in pricing. The other person may not be really that interested in having these lock-in of pricing, because in the inflationary situation, who would do that? Today, even like for example, for various IT companies, they have a visibility of 4 to 5 years when they are deciding the contracts, because majority of the contracts are long-term contract only. But beyond a particular period, hedging is not, foreign currency fluctuation is not passed on to them basically. So for a long term, keeping the fluctuation benefit or cost on one party is always not possible. So it is only for a limited period. But in that limited period window, sometime the impact can be very, very significantly negative, mainly when a situation is that your imports are higher than exports. Anyway, I think, for the time constraint, maybe I will straightway come to the answer logics so that we get a perspective here. So long-term vendor contract offers procurement cost predictability, helping preserve margin stability and EBITDA. Advanced ordering and bulk shipment scheduling also reduces logistics overhead. However, long-term vendor contract also have the effect of opportunity being lost when the current market price becomes lower compared to the contracted price. An ideal strategy for the company could be to look long-term vendor contract for part of the requirement while leaving a part open to market price to match the risk appetite of the entity in respect of market price change. Midway, a hybrid approach has been adopted. Similarly, the SKU rationalization reduces production complexity. It cuts wastages, optimize batch size, directly improving per unit economies. However, aggressive pricing risk losing market segment if customer demand is misread. So this is also a big danger. Now, balancing margin protection with market coverage is key to sustaining cost efficiency and profitability. So I think from the strategic cost management point of view, particularly rationalizing low margin SKUs and focusing on higher margin variants with better volume traction, how the benefits and risk of SKU rationalization is improving cost control. So these are the ways in which it can be rationalized and improved. Now we come to scenario 3. Now again, compliance related aspects. So here, GG Kenya has begun exporting its cereal bar product to neighboring Comesa market through Kenya Export Promotion Scheme. During an internal audit, it was discovered that export prices for 2 large consignment were not submitted for VAT exemption processing within the statutory 21-day window. As a result, the business risks losing input VAT credit for that period and may be liable for penalties under Kenya's VAT Amendment Act. This lapse occurred due to absence of a formal export documentation checklist and the lack of system alert for statutory deadline. Given that export constitutes around 30% of the projected year 3 sales, compliance risk now poses a direct impact on cash flow and margins. With respect to the investment made by Golden Grain Naturals Private Limited from India into GG Kenya, it reflects that prices have been fluctuating between the currencies of the two countries over past 20 years. And particularly in the last 5 years, there has been a steep climb. Each INR for, from being near Kenyan shilling 0.5 has become around 0.65. So this is the fluctuation with respect to a parent company in India and this Kenyan project company. So question is, number 1, what internal control mechanism should GG Kenya implement to ensure governance over tax compliance in multi-country operation? Very interesting question. Secondly, what can Golden Grain Natural Private Limited, which is the Indian parent, the Indian promoter company, do to protect its receivable from GG Kenya by way of royalties, etc.? Third, what is the FEMA compliance that Golden Grain Naturals Private Limited should have ensured for its investment into GG Kenya when they contributed capital into the company. See, these are very, very important governance and compliance aspect that we are talking about. Again, it's an integrated business servicing. So here we are more focusing on compliance. And when it comes to overseas investment, etc., FEMA comes into picture. RBI compliances comes into picture, and they have to take care. So I think these questions are directly targeting those aspects as to what tax compliance in a multi-country operation one should consider. Similarly, when you have subsidiary receivables in a highly fluctuating currency regime, what kind of actions you should consider. Similarly, RBI and FEMA compliance, what are those? So I think I will straightway take you to these answers from the time constraint point of view, that with respect to the first compliance, GG Kenya should implement a tax calendar with automated alert, a monthly internal audit of GST and VAT filing, cross verification protocol between dispatch, invoice, and tax teams. Then ERP integration for compliance tracking. These control will protect firms' export margin and reputation in the new market. See, these are very important point which our team have gone and given in the first year of what you can say, operations, where we found once I would say the organization has set up their project and operation has started. The Indian promoter asked some company to look for these compliance review, and since we have international what you can say affiliate entities in African countries, so we have used them and provided services, and accordingly they have come out. So it's a normal internal audit point. It is not a big thing because any internal audit will definitely look for these local compliance requirements. So we found that there was no automated alerts. The monthly filing, etc., is not being validated by any third party. So there were instances of delay, etc., and there were no basic reconciliation and verification protocols between three key aspects of any billing or sales, that is dispatch, invoicing, and tax related reconciliation. And the ERP were not having a compliance tracking. It was all manual. So I think these are the obvious audit points, and for which the tax compliance internal control mechanism protocol were instituted or improved. Similarly, for the second question, that what should be done by promoter Indian company to protect its receivable. So the answer is the promoter should look at options to hedge the receivables from Kenya to protect the conversion rate so that any fluctuation does not affect the ultimate realization in a unplanned manner in India. I think one of you have already indicated hedging. So it's really the hedging requirement of what you can say Indian promoter, which is more critical, because there is a foreign currency fluctuation wildly with Indian currency as well. Now the third is on FEMA and RBI compliance, where it is indicated that at the time of investment into GG Kenya, the promoter should obtain a valuation to support the pricing at which the investment was made. It should have also ensured that company's total foreign investment exposure does not exceed 400% of its net worth. It is also pertinent to inquire into restrictions and requirement in Kenya for foreign investments to be affected. The foreign investment registration would be required with KEL Invest and Kenya Investment, and also these are presently no exchange control restriction in Kenya for repatriation of royalty and dividend. However, there is a taxation under DTAA at the rate of 10% on these, which has to be deducted and remitted by GG Kenya before remitting the balance amount to India. So students, just see how This case study is providing you a next level of taxation compliance, the RBI regulation requirement, the hedging aspect requirement, and then of course the local level control mechanism with respect to the tax filings to avoid major hiccups in future. So this is a very classic scenario analysis which you should be taking note of. Right. So now we come to the last 5 final points for our discussion on this second case study. So you can now see the table which talks about the initial line and second line capex, equity contribution, ROI, sale in year 3 and PBT. Now here very clearly we know that the initial line 1.8 million was the investment, and in the second expansion, second line 700,000 was the capex. In the earlier scenario, 60% contribution, and we decided that we will go for external funding only. We will not dilute the contributions. So again, 60% is the expansion, equity contribution. ROI in the first line was 22%, and sale in the third year is $2,376,000. Now, in case of expansion, it would be 1,188. Now, given the fact that PBT is expected at 10%, now you should tell what would be the combined ROI with the second line also in place at the above metrics. So it is a deliberate good question that has been asked, whereby the second line or second expansion ROI is kept as blank. However, the question is asking that once we combine the second line ROI, what would be the ROI that we are looking for? So you have to now first calculate the second line ROI, then you have to have a combined ROI, and then you have to tell what is the figure. So should you try that? 20 seconds. What would be the combined ROI with the second line also in place in the above metrics? $15 to go.
%24.
10 seconds. Oh, very good. I think you have cracked it perfectly fine. So PBT on combined basis would be 273.6 plus 118.6, because it is 10% PBT, you can see, and equity would be 60% of both this. So it comes to this. So 24% is absolutely a correct figure. Good. Now, cost management related MCQ. GG Kenya's unit costing reveals that raw material and packaging make up 60% of the total per unit cost. Also, EBITDA is 20%. If a cereal bar sells for 20 and material cost increased by 5%, what would be the new EBITDA? Simple question. 15 seconds.
17%.
Yes, absolutely good. Fantastic. I will not now go in reasoning because you have already calculated it rightly. Now we go to the third question. It's a VAT filing timeline related, compliance related. So under Kenya's VAT Amendment Act, export invoices must be submitted with a specific window for VAT exemption eligibility. Now GG Kenya missed this deadline for 2 consignment. What is the statutory deadline for filing export invoices to claim VAT exemption? I think somewhere in
The question also it was
21
mentioned
days.
21 days.
yes, exactly. Yes, you are right. Perfect. Good. So I think students are attentive. Happy to hear that. Fourth question, financial planning. It is on break even contribution related. So GG Kenya projects that break even will be achieved in year 3 if the annual fixed cost is around 3.3 million and the average contribution margin per unit is 5. How many unit must be companies selling annually to break even?
6.6 lakh units.
Very good. Okay. ROCE versus cost of capital. GG Kenya projected ROCE in year 5 at 24%, while the cost of capital is estimated at around 13%. It's a weighted average cost. What does this indicate from a value creation standpoint? Whether it is a negative value creation or break-even capital efficiency or strong economic value addition or dilution in stakeholders' return.
Strong economic value addition.
Okay. Any other answer from anybody?
So because ROC is being greater than the weighted average cost, so that's why I thought about that.
You are right. Absolutely. Absolutely. अरे कोई तो गलत बोलो. I think every question has been answered with very good speed and with good accuracy. Good, great. I think so. These were the MCQs, and I hope you have liked this second case studies well. But again, this is also very good. So a chartered accountant is going to provide good level of strategic advice to various clients, and it cannot be restricted to only one specific area or field. These two case studies are classic examples whereby we have covered governance, compliances, cost management, finance management, operational efficiency. You talk of any aspect, it is there. So it's an all round improvement exercise that has to be considered. So with this, I think we are through with our two case studies for the day, and I think we are through with the time also. So I have exceeded for some time, but if we have any question, we can deliberate. Otherwise, I would hand over to the host to take the closing proceedings, please.
Now it's time to winding up. On behalf of everyone here, I would like to sincerely thank CA Rajesh Sharma sir for taking time out of his busy schedule to be with us today. And we truly appreciate the way you explained how tax laws, financial reporting, regulations, auditing, and business strategies are all interconnected when a company wants to grow in a sustainable manner. Sir, you discussed the two case studies in a wonderful and engaging manner, making even complex situation easy to understand. Your discussion on the case studies GG Kenya involving international operations was particularly insightful as it also covered how cross border business regulatory requirements, financial decision regarding hedging, taxation, even strategic considerations come together in real world situations. Sir, your insights have given greater clarity, confidence, and a practical approach towards case study based questions. We are truly grateful for your valuable guidance, time, and wonderful way in which you made the discussion so meaningful and engaging. To all students who joined today, especially Radha and Yogender, thank you for your active participation and good questions. Your interest made this session even more meaningful. Keep learning, keep exploring, and most importantly, keep practicing. Wishing you all the very best in your preparation. Once again, a big thank you to Rajesh sir and to everyone who made the session a success. Session is over.
Yeah, thanks. All the best. Yes, thank you.
Thank you. Thank you.
Thank you, sir.
Thank you, sir. And Deepak, sir, especially I want to appreciate you also, along with Rajesh, sir, though, is that. But, sir, the way you provide the overall general perspective about how to be a business analyst in that scenario, that has actually opened my mind to a lot, in a huge hemisphere. That's why I'm able to answer the questions and I'm able to strategize it. So today, because of your contribution, also I was able to do that. And thanks to Rajesh, sir, also to bring amazing case scenarios. Thank you.
Great. All the very best.
Welcome.
Yeah, welcome.
Welcome. Sanket? Yes, yes.